Welcome to TheoTrade, doing the weekend update here on September 3rd, 2016. Quick reminder to everybody, of course, the markets are closed here in the U.S. on and for Labor Day, which of course is September 5th, 2016. What we're going to start with this weekend update here in the iridescent looking box, it's all about what we call the hedge. That's what trading is right now. So let me kind of bring you up to speed at what you happen to be looking at on your screen right here, right now, in the S&Ps. So we're looking at the S&Ps. Now, the reason I'm using the S&Ps, and you could use the SPX, you could use the S&P Futures, you could use the spiders. Listen, whatever does it for you. The S&P Futures, the reason I use them, well, they drive order flow to the marketplace. And what you happen to be looking at right now is from, roughly speaking, right down here, July 15th, okay, to our current date, which, again, we're looking here September 3rd. Now, this is fairly staggering if you recognize that this chart just happens to be nothing more than, 6-7 weeks of trade, all in the neighborhood of roughly this, 2155, right into the neighborhood of where we currently are. Some of the highest readings here, about 2185. Now, the reason I say it's all about the hedge, trading right now, could we open up the side and look at the, 50 different underlyings? Absolutely. Well, let's look at Google. Let's look at Facebook. Let's look at Apple. They don't matter. Let's look at the XLF and the financials. All right, the financials have been in motion a little bit, but they don't matter. What matters right now, and when I say it's all about the hedge, okay, algorithms pretty much have gripped hold of the market in this particular range. And I want to explain exactly what the hedge kind of entails. And again, if you're worried about like the iridescent box that you could barely see here, don't worry about it. What's important is to recognize how much trade has actually persisted inside of an extremely tight range. Now, when I say it's all about the hedge, the hedging activity has become completely and utterly transparent inside of some of this recent trade. What the hedge basically means, it has to do with the dynamics of the marketplace. Think about it this way. A firm has drastic risk on, okay? Now, this firm, it could be a hedge fund, it could be a proprietary trading firm, all right? It could be a number of different entities out there. But for the most part, okay, these large trading entities, these market-making firms, they're not taking a tremendous amount of directional risk in the marketplace. In fact, and some people maybe are not aware of this, part of the Dodd-Frank legislation, specifically the Volker rule, even prohibits, okay, some of your what we term too big to fail institutions from even taking substantial amounts of directional risk within the equity markets. Now think about that for a second. So the regulations basically state, well, Mr. Bank, you're going to have to go ahead and mitigate your risk. So they mitigate the risk. They control their directional risk. They're able to trade in all kinds of markets so long as that trading, right, falls under the distinction of what we term bona fide hedging activity. Now, nobody really knows what bona fide hedging activity is, like how much directional risk you're really able to take. Again, some of the areas of the Volker rule have yet to be enforced, but most of the banks are already adhering to this rule. So what they do is they hedge with the dynamics of the market. It basically means if the market goes up, what do they have to do? They turn around and they buy S&P Futures. If the market sells off, what do? They have to sell S&P Futures. Again, they're hedging with the dynamics of the market. In fact, it's called dynamic hedging. Today, it's a little bit more complicated than it was. Like the term dynamic hedging was really kind of on the forefront of the news after like the crash in 1987, because that was the first time that we ever really saw really the wreckage, if you will, of dynamic hedging. That is, when the markets were crashing in 87, traders had to sell into it, okay, to mitigate their risk. Well, what you're getting, all right, right now, and it's very, very transparent, is the algos are all dynamically hedging. And what's become extremely transparent is every time that we crack a very, very tight range in the S&Ps, the volume Okay, for instance, right here, this volume would explode. And I'm going to show you that in a moment. The volume explodes anywhere above, okay, 2180. The volume is also exploding anywhere below 2160. And this is a range that I talked about last weekend on the update. Okay, I talked about it the weekend before that. But what's becoming more transparent, okay, is how much risk is really in this zone. All the trade that we've seen for 7 weeks persists in this tight range. All it does is just continues to accumulate. How much hedging activity? And every time that we crack the range, okay, the volume it's just off the chart, literally. Okay, 10, 12, 15,000 S&P contracts will trade per minute when we start to crack the range, which, if you want to look out to next week, and again, it's going to be a shortened week, right? Got Labor Day coming up over there. Everybody here in the U.S. has the barbecues all fired up. All right, maybe I don't have the barbecue fired up, but I have family here, hence why I'm hiding in my office right now. Nevertheless, the thing you have to think about in this next week of trade is the range right now is starting to expand. Okay, what we've seen, and now I'm going to go to some more recent trade. Let's just cut right to it, right? I don't think we need our little box. By the way, to put this box into context of the greater S&P, it is amazing how flat markets have really been. So we're going to go ahead, remove the drawing out of there. What I want you to see is in some recent trade, the range, okay, is starting to expand. And we've actually been tagging 2160. We've been tagging this 2180, okay? Almost every other day out there, we're tagging the upside, tagging the downside. And the volume in the S&P Futures, okay, is, in fact, starting to expand as you crack those ranges. More appropriately, let's actually get into 1 minute trade over here. When I say 1 minute trade, what you're looking at now, this was yesterday's trade. That's Friday, September 2nd, right? The jobs number came out in the morning. It's pretty amazing. The jobs number's bad. Let's rally. Think about how distorted markets have become. You know, markets have always been, you know, since I started in this industry, they say it's the most efficient mechanism. It's about price discovery. How good is price discovery when not so good news comes out? You know, the jobs report's supposed to be about 180,000 jobs. What do they hit? About 150,000 jobs. They're like, yes, it is bad. Let's buy. You're like, wait, what? Yes, it's bad. We must buy. Why? We don't know, but we think the Fed might do what? Are they going to raise interest rates out there? Okay, because what's strange is the bonds actually sold off like they're going to raise interest rates. Wait, bad jobs report doesn't mean they're going to raise them. That means they're probably going to hold them still. Okay, the exact opposite of what you would have expected probably occurred. With that, what I did want to kind of enunciate, if you start to zoom into some of the trade over here, again, this is just the first few minutes of trade during the session, which we always see big bursts of volume. But I wanted you guys specifically to see when I talk about crossing thresholds, okay, 11, 12,000 contracts being done, okay? And again, every time we're crossing through, all right, major ranges, we're seeing these spikes of volume. And I went back in several recent trading days, again, that 2180, the 2160, they start to explode with volume. Right now, again, it's all about the hedge. What does this mean for you? You know, that's what you got to put this stuff in a context. What does it mean for you? What you want to watch is when we start to crack in the S&P Futures, and we're right there. Come on, we're 2180 pretty much. That's where we're closing. Why do you think we closed there? Because how much activity persists at that particular level. If we forge a little bit higher, what it's going to cause every firm on the street to do is to have to buy into it. When we start to crack above 2180 and starts to substantiate higher, they're going to dynamically buy into it. It's going to feel like a short squeeze. The opposite is also true. We crest back through, okay, the 2160 level, and activity in markets is going to absolutely spike. And again, if you look back over the last 4 to 5 trading sessions, and I'll pull up 4 or 5 trading sessions just in a 30-minute, you can see when we started to actually crack these ranges how heavy volume has become. We stopped here at 2160. That's back to Wednesday. We actually cracked through the 2160 range. Things got wild. They got volatile. We cracked the range again right up to 2180. Volume absolutely spiked. It's, again, classic symptom of dynamic hedging. The issue, though, that really persists right now is how long we've been in this range. And again, that accumulation of risk, and something I've been talking about for 3-4 weeks right now, is hundreds of billions of dollars of risk are being piled in here. Okay, we're still, for the most part, in a very binary marketplace. And that means you can look at all the technicals you want out there. You can tell me how bad or how good you think the economy is, right? Nevertheless, the risk, when I say is completely binary, this has nothing to do with events. This has everything to do with the fact, okay, that the risk is there. We crack above the range, right? Trading firms are going to go out and buy. We're going to explode to the upside. I would have to say that my best interpretation of what is likely to play out inside of probably this very next week coming. And again, now we're talking about the week, right? When I look forward, I'm always trying to be as forward-looking as possible, September 6th through September 9th, okay? My inclination here, and again, this is based on having watched dynamic hedging, for the past 18 years, I think we're probably going to explode to the upside met by extreme sell-side activity. Look for it, okay? Right now, again, don't trust some of the volatility out there. If you see a VIX that's, under 12, don't get too excited. Doesn't mean very much. Volatility right now being suppressed. Again, this next week, what do we have in terms of news? Not a whole lot, okay? Well, we do have the Apple iPhone 7 coming out. Oh, I bet it's going to have maybe wireless headphones. That'll be amazing. It'll be a phone with a camera. Being a little facetious on that front. Nevertheless, it is a piece of news coming out this particular week. But even when you start to look at products like the financials, the volatility is rather sedate. Okay, only expecting what? The financials, for the most part, for 4 days of trade, about 46 cents of movement. It's not a lot. Just on Friday alone, these things had almost a 30-cent expected move. Nevertheless, look for it. Okay, these ranges I'm talking about in the S&Ps, we crack above that 2180, explosive moves to the upside, followed, okay, by some volatility and possibly some downside volatility. Again, as I said last weekend, we're ready to crack the range over here. We saw us crack the range a number of times. Okay, how ironic we fall right down to roughly that 2180 level to close out this holiday weekend. So everybody enjoy your Labor Day. Have a great holiday weekend. And for those of you, if you would like, stay tuned, because next week I'm actually going to be doing another evening class over here. It's TheoTrade.com/short. I'll talk about it here for just a moment. Again, TheoTrade.com/short. I want to thank everybody for attending last week's not only RSI Legree. Yes, I'm able to pronounce it, the RSI Legree indicator. If you guys are still interested in the RSI Legree indicator, of course, we can provide that to you. We don't charge for any of the indicators over here. Also, we did a thinkorswim demonstration. That's also out there and available. If you wanted to know more about thinkorswim, fantastic. Here, this is something I feel really strongly about. I'm going to do a session. It's next Wednesday, September 7th. Okay, 7 p.m. Central Time, TheoTrade.com/short. What am I doing there? Well, first of all, I'm going to talk about how volatility is near record lows. Okay, learn why the markets are they're not blind to the risk, but the volatility is being suppressed. I'm going to talk about it extensively. And really not only to show what your exposure happens to be, but more importantly, talk about strategies that we can employ to control risk. And if you don't have a lot of positions on right now, then potentially make a lot of profitability if that risk is going to hit us, which very much looks like we are headed for some extreme risk out there. Again, check it out over here at TheoTrade.com/short. Again, enjoy your holiday weekend. Thanks a lot, everybody. Bye-bye.